I'm going to show you my $200,000 portfolio. This is the portfolio that will help me reach financial freedom. Portfolio you can copy as well, especially if you're a Canadian, but obviously this is not financial advice. I'm just showing you what I do and the reasoning behind every stock I own, every ticker that I own, and it's not that complicated. It used to be a lot more complicated, but the reason that why I've waited so long to show you is because for a moment in time, I wasn't following my own advice. I thought I could beat the market. It wasn't until a few months ago when I finally sat down and I started reading up on the research, looking at the studies and the statistics and the facts that I realized, you know what, like I do need to just own a well-diversified portfolio. I need to follow my own advice, follow my own key takeaways that I've learned from reading the tens of books, 20, 30 books on personal finance and investing, and I just need to do it. Coming from a financial background, I thought I could always beat the market, but the matter of fact is that over the last 10 years, I did not beat the market, right? I've got times when the S&P was up 25%, I was up only 10. And so it makes more sense after 10 years of trying, not beating the market, to just follow the market, right? If you can't beat them, join them. And so let's look at the portfolio. And so before I continue, I want to show you that I actually do have a portfolio. This is literally my bank account. And so in USD is about 160,000 in Canadian dollars. It's about 219,000. I'm not gonna show you any of my account numbers, and so let's end it there. This is the actual portfolio. I have everything tracked on another tab, and you'll notice it's exceedingly simple. I am not one of those gurus that own 20 different stocks and then tell people to buy index funds. That's just because this is my core portfolio. Will I do that one day? Maybe, but the only reason why I would do that is because I have extra money that I can throw at the market that I am ready to lose because I am already meeting my financial goals. So that's actually the setup that I think works for so many people. Is first, you want a well-diversified portfolio that takes care of your wealth building, long-term wealth building, one that you can build wealth reliably with. And then if you have a little bit of money left over that you want to throw at crypto or stocks, then be my guest. Satiate your urges. It's better than doing it from the core portfolio. And so you'll notice that I only own 3 tickers: XEQT, AVUV, AVDV. You'll notice that I'm up about $3,000, but that's only because these purchases were made recently. And in terms of recently, I literally mean last month, about 3 weeks ago, was when I sold every single position that I own, and I just decided to get these 3 tickers. And so to summarize, I have 80% of my money in XEQT, 10% in AVDV and AVUV. And now you're probably thinking, what the heck are these tickers? So let me show you what XEQT actually owns. It owns ITOT, which is a total US stock market fund, similar to VTI. It owns XIC, which is a fund that tracks the Canadian stock index, TSX. It owns a bunch of international stocks. It owns the S&P 500, so it's more weighted in the S&P 500 because the S&P 500 has performed well in recent years. And it also owns emerging markets. So these are your Chinese stocks or your stocks in Japan, India, and then it has USD cash and Canadian cash, just a little bit of that. And so this is a very well diversified portfolio. For most people, this would be it, right? If you want to take full advantage of the world market beta, and beta, by the way, is just a way of saying average returns in the market. If you want average returns in the market, this will get you average returns in the market. And so you might be thinking, but the S&P 500 has outperformed every single other index over the last 20 years. Yes, it has, but it has not done so for every 20-year period for the last 100 years. Think about the time when it was 2000 to 2010. The S&P 500 did not perform that well during that time. It was called literally the lost decade for American stocks. Dot-com bubble, 2008 financial crisis. At that time, we had small cap stocks and international stocks that were doing okay, right? Not exceedingly well, but better than flatlining. And so the reason that why I own AVDV and AVUV, they are for the same reason. So one is a US small cap value ETF, and one is an international small cap value ETF. And so there's this whole idea of factor investing, which says if we expose ourselves to factors that cause the risk premiums in the market, one of those factors being small profitable value stocks, then over the long term, we increase the probability or likelihood of getting more outsized returns. And so me owning AVDV and AVUV is just a way for me to expose myself to smaller cap stocks, which traditionally have performed better than large cap stocks over the last 50-70 years. Yes, but as you all know, over the last 10 years, the S&P, in fact the Magnificent Seven, has done exceedingly well, but believing that they will continue to do well over the next 30-40 years and perform similarly, I really think is a case of recency bias. Okay, so you only notice I only own 3 tickers, and none of those are bonds. I don't own any bonds, right? But I thought as we age, we should increase our bond allocation. Well, not necessarily. I get that from this article. And so beyond the status quo, a critical assessment of life cycle investment advice. So what the researchers did was they did a study and they simulated millions of different portfolios invested over different time periods across different developed countries to see the optimal portfolio for long-term returns and how much we have to save relative to our portfolio results. TLDR, 33% in domestic stocks and 67% in international stocks is the ideal weighting for a portfolio that will outperform pretty much all other asset allocations, including target date funds, including a 60-40 portfolio. Now, one interesting thing of note here is that 33-67 is the optimal, but really any percentage between around 15% to 60% is okay. The only difference that will make is it will increase marginally your savings rate required to reach the same result. But if you do believe, like me, I believe that the US stock market will continue to outperform international stock markets at least over the next decade, then it might make more sense to adopt a position that is tilted towards the American stock market a little bit more. And that makes sense because the American stock market literally makes up 65% of the international stock market, like the world stock market. And so based on this article, and feel free to read it, you can probably find it for free online. It's quite a long read and there are quite a few kind of finance specific terms, but if you actually sit down and have a read through, I'm sure you'll learn lots. But the TLDR of this article is just invest in equities over the long term in a well-diversified portfolio. That's my core portfolio, and that's what I'm building wealth with. And until I meet my savings goals and more, right, I will not buy any crypto. I will not buy any stocks, individual stocks, even though crypto has literally been the highest performing asset in the last, 50, 100 years. But that's just not something that is within my realm of expertise to understand. Anyone that doesn't know how a blockchain works, how cryptocurrency works, shouldn't dabble with it until they figure that stuff out. So this has been my portfolio. As you can see, it's right now valued at $219,000. Funnily enough, just a year and a half ago, it was $100,000. And also a year and a half ago, I decided to sit down and get serious about my family's financial future because I want to set them up for success. And so I built for myself a financial system that automatically saves and automatically invests. And so if you're someone that wants to do that and implement that system, click the link below. I'd love to chat with you.